Next guest says upside risks to the economy have diminished, but she still expects a soft landing. Kelsey Berro is fixed income portfolio manager at JPMorgan Asset Management. Kelsey, great to see you. Why have they diminished in your view?
So I think the reason that the upside risk has diminished is primarily a function of the, I would say, order of sequencing in terms of the administration's agenda. So there was a number of things that the market was very optimistic about at the start of the year, particularly tax cuts, deregulation. Some of the things that they were more concerned about, tariffs, were not really front of mind. What's happened is we've seen a significant deterioration in both consumer and business sentiment as a result of the escalating trade wars. We unfortunately don't think that's going away anytime soon. You have the uncertainty is a cloud that will continue to be swirling around us at least until April 2nd. And as a result, we've already seen enough indication in the data to suggest that growth is moderating, but it's moderating from a very strong place. And that's an important distinction, right, is where did we start? Because we do have headwinds to growth that we're seeing emerge, but we're coming from a very strong place when it comes to consumers and corporate balance sheets heading into 2025.
I think it's interesting that you phrased it as, I'm not sure if this is actually your wording, the upside risks have diminished as opposed to the downside risks have increased. Is that your wordsmithing or?
Well, I do think the downside risks have increased, particularly as it relates to treasury yields and yields in the bond market. Right. So if you think about the risk reward, I think that the upside risk to yields are now much more capped. And the downside risks to yields, on the other hand, we could see them come significantly lower if we were to see some of this downside risk really materialize.
So what are we seeing? What does a 4.21% yield on the 10-year tell you? Is that a reflection of the growth scare? And if a growth scare becomes a growth slowdown, an actual slowdown, what should that yield then be?
So I think that the yield should probably be moving lower below 4%. Okay. That would be an indication that risks of recession are materially rising. What I would be looking for to really assess if we're going to see that shift is the labor market. So the Fed right now is in a bit of a waiting period, wait, hold, see, because inflation is still not at their target. What will really get them to react and to consider rate cuts this year in a more aggressive fashion, more than the two that they currently have in their dot plot, is if you start to see the unemployment rate rise and you start to see initial claims start to really pick up. And we're not seeing that in the data yet. And that's why the Fed is very comfortable on hold. And that's why we're kind of in this middle of the road area in terms of our expected range for the 10-year Treasury, which we think would be around 3.75 to 4.25.
So you're a fixed income portfolio manager. So what are you doing now? How are you positioned?
Yeah, so the way that we're positioned, this has actually been a very good time for fixed income so far this year. So just to set the landscape, why do you want fixed income in your portfolio? Well, diversification against your volatile equities, liquidity versus your alternatives that may not have a mark to market but are locked up for a long period of time. You have the S&P 500 that is down about 4% year to date, where your bonds are up 3%. That's not just treasuries, though, up in price. Investment grade credit is up in price. Agency mortgages are up in price. We see a lot of value of maintaining duration, but also having a lot of carry in our portfolio. So we still see company balance sheets as very healthy. So we're investing in investment-grade credit. That's one. Securitized credit as well, asset-backed securities. And really, what we're seeing right now is fairly substantial demand for fixed income across the board.